Following significant premium declines in 2022 and 2023, U.S. title insurance premiums bounced back in 2024 on the back of interest rate cuts. Here to discuss the segment and how current economic challenges may impact title insurers are Modica, Director, Credit Rating, Criteria Research and Analytics, and Kourtnie Beckwith, Senior Financial Analyst. And Kourtnie, as mentioned, title insurance bounced back in 2024. What's driving that?
So the factors that led to the bounce back in 2024 for the industry were stable mortgage interest rates. When you have stable mortgage interest rates, we saw an increase in home loan originations. We saw an increase in the refinance activity, which was pretty much non-existent the year before because interest rates were so high. The option that we saw was most common for refinance was the cash out option. And then lastly, commercial real estate. Commercial real estate accounts for about 15% of all title premiums. And I think it's important to mention that because they have higher revenue because of the loan amount. So those three factors increase title premium revenues 7% year over year.
Interesting. So what are we seeing so far in 2025, Kourtnie?
So the first 6 months of 2025, we've seen an extension from 2024 when we look at those metrics. Rates are still stable. Interest rates were cut twice at the end of 2024, which led to that continued premium growth. When we compare the first half of 2025 to the first half of 2024, net premiums written increased overall 13%.
And despite these improvements, is the housing market on solid footing?
So after the last few years, the housing market has been relatively stable, but has also been defined by conditions that have created imbalances, right? We have higher mortgage rates, limited housing inventory, as well as limited mobility due to mortgage rate differentials, and these have collectively played a role in the supply and demand imbalance that we're seeing. If we look at the mortgage rate differentials, currently approximately 2/3 of mortgage holders now have mortgage rates at below 4%. And if we compare that to the 2025 30-year fixed rate at 6.75%, it's not really hard to see how this rate differential has caused some friction in the housing market, with current homeowners really holding on to that lower rate. And this has led to a further reduction in housing inventory that was already limited due to years and years of underbuilding after the global financial crisis. And despite the higher mortgage rates, housing prices haven't really dropped because supply still can't meet the demand for housing. So the last thing I'll mention is the lack of affordability. You know, when we combine these factors, there's been a sharp decline in housing affordability. The Fed puts out a housing affordability index every month, which measures the share of median household income needed to purchase a median priced home. And affordability has reached one of its weakest levels on record. Using the 30% of income as a traditional threshold for affordability, the index shows that a typical household would now need to spend roughly 48% of its income on housing costs, you know, just underscoring how stretched the market has become.
So is this rebound sustainable, or are there other factors or uncertainties that could trip up the economy?
So in my mind, the largest uncertainty is the path of interest rates due to the high sensitivity the housing market has to Fed policy. While the Fed did cut rates in September, the first time in over 9 months, I think we have to look at the pace and depth of future cuts, and this really remains uncertain right now. While median forecasts for the future Fed funds rate call for 225 basis points cuts by the end of the year, the committee members had a wide range of individual opinions, with some seeing no further rate cuts for the year. And then, you know, there's always the potential for a slowdown in the economy or a change to household balance sheet strength. We have seen a rise in delinquencies for auto loans and credit cards, but that really hasn't trickled down to the mortgage delinquencies yet. I mean, and this is likely due to the fact that homeowners tend to have a strong credit profile on average.
Kourtnie, what would tip AM Best's outlook on title insurance back to stable?
John, that is a common question. So what I would say to that, there's a lot to consider when we're looking at the outlook and the headwinds. We consider premium levels, we consider mortgage interest rates, we consider unemployment. We also look at recently the tariffs. Are they on? Are they off? And how the tariffs will impact the pricing for supplies for home builders and the lack of inventory. And then more recently, the federal government shutdown. So those are all the factors that we look at when we're considering the outlook. Is kind of, we're 5 months out, right, until the outlook comes out. So what I would say to that is stay tuned. We'll publish the outlook in March of 2026.
Stay tuned. Kourtnie, Ann, thank you so much for taking the time to speak with us today.
Thank you.
Thank you.
That was Ann Modica, Director, Credit Rating Criteria Research and Analytics, and Kourtnie Beckwith, Senior Financial Analyst, AM Best. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.